Hi friends, welcome back to another beautiful day. Last day we have seen about how the market has gone up and the three factors of the sentiments, the liquidity and the growth factor. And I have left out the most important, the PB ratio and the PE ratio and the dividend yield ratio, how it is going to affect the market, how the market is going to come down or whether it is going to move up. All these things we will have a detailed look in this episode. Please post your comments and you are free to ask any questions regarding that. And please like the channel. If you have liked the video, please subscribe the channel. This is KARMANTA Research and Analysis and myself, V. Ramesh Kumar. Hi friends, in the last episode we have said that the growth has been nullified or the growth has been discounted by the Indian stock market. The growth doesn't mean that it's GDP growth alone. The growth has got some relation to the share prices. We normally speak about EPS. EPS is earnings per share. The EPS is related to the company's profit. How much profit that your share or the company has generated over a period of time, which directly reflects in the share, the dividend that is being provided. So, the earnings which the share receives more than the share appreciation, the value appreciation which happens as a trading instrument is more important in valuing a share. From there, we will move on to the most important factor, the PE ratio, the price earning ratio. So, we have seen the dividend or the earnings of the share, the company's share price to the company's earnings per share. So, something which X is the company's share price and Y is the earnings per share, how much the share has got its earnings by way of dividends which has been given by the company, the profit that has been generated. This is an indication whether the stock is a good buy or not, and how many times this trades in the market is the PE ratio. So, we will see that in detail with an example. Suppose we know the share price of Infosys. Let's forget about the actual share price. We will see that the share price is at 100. The share price of Infosys is today at 100 and the earnings is 5. And how much will be the PE? Price to earnings is 20. That means the stock trades at 20 times in the market, which is the normal calculation. The same share, if the share price is 100 and it is the yield or the dividend for the share, the earnings is 10, means it trades at 10 times in the market. And if it is 20, then 100 to 20 is 5 times. Here we see that the share price is kept constant. The share price doesn't move. We have to calculate when one is constant. And now the thing is that the share price doesn't remain constant. The share price moves upward or downward. So, the P has to come down. If the P has to come down, price to earning has to come down, either the earnings should go up or the share price must come down. Make it very clear, or the P of the Indian stock market will come to that. We have got a P for the Nifty, we have got a P for the Sensex. So, if the ratio has to be in the lower levels, either the price has to come down or the earnings has to go up. This means that if the PE is very low, say 10, 5, 20, less than 15, which means either the price is low or the stock has got a very high earnings, which we have to check the fundamentals of the stock. Before we purchase a stock, we will have to check the PE ratio where the earnings are high or it is unprecedentedly bought for trading. This is the one thing. So, where should be the moderate PE for the Indian stock market, for the traders range or the investors range? I am talking about the point of view of the investors. The traders have got something to do with the market, something else to do with the market, which we will talk later. The Nifty PE on 24th September 2021. 24th September, we know the Sensex touched 60K. The Nifty PE was 27.34, which means the Nifty is trading 27.34 times its what we call its price to earning ratio. This is the average of the 50 stocks of the Nifty, as we all know about it. And how does this matter? For which we will have to go back to the history of the PE ratios. Having learned a little bit about how the PE ratio actually is, we will see how the market has got its effect on the PE ratio. The PE of the Indian stock market, historically, I have got the chart with you. You can view the chart. It is a chart from the supplied by the NSE. NSE has supplied this chart, and the chart shows some surprising facts. The facts include in 2001, when the market was almost going up, had its momentum, the PE ratio in February 2001, it was at 21.32. And in 2004, when the market almost peaked at that point of time, the highest at that point almost crossed 4,000 in the Sensex, it was 21.02 again. Then we had seen the biggest correction in 2008 after the subprime crisis that erupted in the US. The Indian stock market also corrected, as we know, the January and February of 2008 that has spread so much panic in the Indian stock market. The PE at that point of time is 25.33. It's over 25. And then it took another almost 10 years for the market PE slowly moving up, which we will have to say the market, the people who have invested in 2008 is going to get nothing. For the investor is getting very little from the market till 2008, when the PE reached 27.24. Again, we have seen a little bit short correction in 2018 in the Indian market, and after that the market was moving up. The market moved up, and now the 2021 PE of the Indian stock market is 27.34. The price earning ratio, either the earnings must have magic increase in the stock market for the PE to come down, which I don't expect is going to happen, or the second option is the what we do not want to happen, but possibly will happen, is the price of the share to come down. Then only the correction in the PE. Historically, we will see that when the market goes up 10 at a speed of 10 kilometers per hour, the market comes down at 100 miles per hour. It is almost 100 times or 150 times the speed of the market when it corrects. So if the market corrects to the PE levels of 12 or 13, it is not going to correct to 12 or 13 overnight. But from 27.34, maybe it goes up to 28 or 29. The market cannot afford to go further. And from there, if it gradually comes to 26, 25, 24, 23 and up to 12 or 13 levels, where does the investor's money be at that point of time? If you keep on investing, or if you keep invested in the market, where will your money be at that point of time? We will check. And next we will go to the price, after that, the price to book ratio, the PB ratio. The price of the stock to its book value. The higher the PB ratio, the more expensive is the stock. So we need to understand the price to the book value, the price of the stock and to the book value. If the ratio we see is higher, then the stock will be expensive, and vice versa. We will see the historic chart of that also supplied by the NSE. We have got the 2001 when the P ratio was at 21, about 21, the price to book ratio is 4.38 at that point of time. In 2004 it was 4.10, and in 2008 when the market fell unprecedentedly, the PB ratio was at 6. and then in 2018 it was 3.6, and today it is at 4.47. If you go through the chart, you will understand that the price to book ratio, where the ranges happen when it has gone up or it has come down. One thing is for sure, the price to book ratio above 4.5, take care of it. The market will have every tendency to correct at that point of time. Again, we have got the third and most important, another important aspect of the market, the technical aspect, the dividend yield ratio. This is the payments the company distributes relative to its stock price. The payment, the dividends that is being provided, and I am so dissatisfied. I am not happy how the Indian companies have the range of this is from 2 to 6. In a prudent, good economy, it should be like that. But we have seen that mostly it was in the range of 1.2 to 2.5. But we have seen again the ratios which we see. The dividend yield ratio in 2001 was 1.19, really low. The market corrected. 2004, 1.45, the market corrected. 2008, again the landmark correction year. 2008 January, it was 0.9, and the market corrected drastically. And in 2018, we have seen it is 1.32, and now the dividend yield ratio is at staggering at 1.11, which means the shares are not satisfied with the dividends that is received. So all the three factors which we have seen, the technical aspects, the PE ratio 27.5, very high, the PB ratio 4.5, almost touching 4.5, really high, the what we call dividend yield ratio really low. All these indicates that the market has to come to a level which is to be in the normal range of trading, where the investors can enter the market. And here I speak about the people, the new almost 2 crore new demat account holders. If you are entering as investors, take care in this market, because the market is riding clearly on liquidity and sentiments. And if you feel that this is a tough session today, because we have talked about the fundamentals, because I cannot keep away from talking about when the market is riding so high, we'll have to talk about the real facts in the market. And take care that the indices and the stocks, most of the stocks are riding high. If now we'll have 2-3 questions for the next session. The traders have no problem. They buy and they sell. When the market goes up, they buy. When the market comes down in a bear market, they go short. They sell and then buy. If the market corrects to PE of 13 or 14 from here, then the halfway level, how that is going to affect. How will it take for the market to come back? If the market corrects to 13 or 14 PE levels, how long it will take for them to come back? So if I hold a stock of say any company, the Reliance Industries, it is trading at 2,500 levels now. If it corrects to 1,000, will the stock come back? See, if I hold on to 2,000, then what will happen to my share? Then let's say the market falls. What will happen? The angel stocks, is there something called the angel stocks? And how the global indices, the Japanese market, the Chinese market and the US market has behaved in the past is also the questions. So these 5 questions, and more important, the 6th one, how should my portfolio look like in such a condition when the market is going up, when the savings instruments or the savings account interest is low? How should my portfolio look like? All these questions, it's a long time today. I think it's a long video today. I cannot keep away from that, because this is an important aspect which I have to speak to you on this, not to caution you, not to panic you. The market you need to understand. Unless we don't understand the market and we enter into the market, the devil lies in the details. So let's have it for today and see you in the next session. Please post your comments, your queries. Please subscribe the channel and like the video if you have liked it. Thank you. Take care.